Welcome to Spiedel's California Minute. I'm your host, Catherine Zidane. This week we're covering what to do in an FTB residency audit. If you need more information on residency issues, attend Spiedel's 2-hour webinar, Non-Residents, How to Become One and What's Taxable, on October 1st. For details and to register, go to spiedel.com and click Webinars. An FTB residency audit will likely be triggered when a taxpayer files a part-year resident return with a large amount of income received after the change of residence. Among other ways, the FTB finds prior residents claiming to be non-residents through a part-year resident return with a large amount of income after the residency change, newspaper articles reporting large court wins, like in the Hyatt case, where the newspapers reported Hyatt's large patent settlement, W-2s that report income as California source, but the taxpayer is excluding the income, or through informants like an ex-spouse, former employees, etc. One of the first things the FTB will do is to determine the number of days the taxpayer spent in California versus the number of days spent in the new state, especially if the taxpayer still has property or lots of family in California. When comparing time in California versus time in the new resident state, the FTB ignores time spent in other states and countries. The taxpayer's goal is to spend very few, if any, days in California and many days in the new resident state. Here are Spiedel's recommendations to avoid a change of residency audit disaster. Plan the move to the other state and truly sever the ties with California. Do not plan to return to California for more than minimal visits, in the next few years at least. Document all issues that point to the date of residency change on the date you'll enter on the tax return. Keep this documentation for at least 5 years and longer if the taxpayer moves back to California within the 5-year period. Alert your client that in the case of an audit, the FTB will look at copies of bank and credit card transactions, employment records, and utility bills if a home is kept in California. And provide your client with a written list of do's and don'ts, including do not keep a car registered in California, do not spend a lot of time either working, visiting, or conducting personal business in California after the move, do file all required tax returns in the new state, and do buy a home in the new state and move the furniture to that home on or before the stated move date. Remember that if it looks like the taxpayer is moving for the sole reason of avoiding California tax, your client will likely lose the residency audit. Clients don't want to accept the fact that selling the house can be pivotal. They'll give you all the emotional, financial, and logical reasons why they should keep the house. They'll tell you that they're leasing the house on a long-term lease. But if they aren't entirely truthful, they will lose. If they change their minds a year or two into the move and either come back or let family members use the house, they will likely lose the audit. When advising your clients and preparing them for a domicile change, dig deep into their plans. Only then can you advise them as to what they have to do if they really want to change residence. Make the break as clean and visible as possible. Because even if you win the inevitable residency audit, the cost to you and your clients of defending a residency audit will eat into their tax savings. Stay up to date with California state tax issues with a subscription to Spiedel's California Tax Letter. You can get details on this monthly subscription and download a sample issue at spiedel.com under Publications. That's all for this week. Join us next time for another episode of Spiedel's California Minute.